My name is Nick.
In progress.
Oh, here we got it. Joined by Brian Healy, who I've known for many years, and we've worked together long ago in Deutsche Bank. Just as a so the course that we're presenting today is Algorithmic Trading: A Practitioner's Guide, and it's going to be a very different sort of course to what one can generally find. And I think this is because of the fact that some of the material has been particularly, we think, fine-tuned to make it accessible for those people who want to use it in practice. So Brian's controlling the slide, so if maybe you could skip forward to the next one, Brian. Okay. And this is our outline for today's small talk. We're just on for a short while just to chat to what it is and why we're planning on doing it. So actually, we haven't decided who's this period between we start with this one. We go over that. Oh, you do what? Why? Okay, so basically, algorithmic trading is a broad term for trading which relies on mathematical models and algorithms. It means any portion of the investment process from data and events all the way through to trading. So as markets become more automated, and increasingly large volume of trades are executed using algorithms. So whether it's high frequency trading shops or prop shops or e-trading, a large portion of this is algorithms. Many exchanges are now dominated by high-frequency market makers, with increased volume and speed leading to higher returns. So algorithms are increasingly part of life in the markets. Algorithms can be used, as I was saying before, for all aspects of the business, from the high frequency to the low frequency, in trade decisions, portfolio allocations, and in placing orders. Some quant hedge funds were always heavily algorithmic from the very start, while some others deploy algorithms as one element of their approach or one portion of their platform. And some shops automate the entire process, some only automate parts. So for instance, it's very common to make the decisions, but then to do voice trades, because perhaps that specific market is something that's not yet fully automated. So you have a voice trader at the very end who picks up the phone and actually makes the trade. But one way or another, algorithms are increasingly used in the markets, and it's something that we all have to be aware of and on top of in order to sort of make sense of things.
Okay, I'll go through who, what, and why. So you're all wondering, is this course for you? And we'll just quickly focus on who it's targeted at. Geoff's already mentioned who Nick and I are, so I won't go over that again. And then we'll look at what's in the course and why one should do this course. Nick has touched on some of that already, but we'll see a bit more. So this course is, I guess, targeted at a number of different audiences. One group is discretionary traders of all types and risk managers. This will help them to understand all the mechanics of the market that, are constantly evolving and in flux, and new and improved algorithmic strategies are having a huge impact on every aspect of the markets. In order to do their job and to make money, etc., they need to really understand the pros and cons of different allocation approaches, execution approaches, etc. More specifically then, and perhaps a little more obviously, those who are already doing algorithmic trading and are quants can learn more about the commonly used strategies, when they work, when they don't work, and in particular of relevance to them is the statistical properties behind these strategies. So what is it that actually drives them from a statistical perspective? And then finally, I guess, a broad group, really, all graduates, students of all types, and data scientists who are looking to gain familiarity with this rapidly growing area of trading and markets, who are looking to get an understanding of the underlying theory and master it, and then learn what the most common strategies are, how they work, how to implement them, and what the principles are. So I won't go over again who Nick and I are. What then is, what are the goals of the course? So our aim is to provide everybody, all students, with a strong foundation in algorithmic trading, including the tools and techniques used in the industries. This again is emphasizing the practical, that industry focus that has already been mentioned. We'll focus on the data sources, how to get them, how to find alphas in them, how to test strategies. So everything you need to know to actually implement and optimize a strategy. Application is central to the course from start to finish. So everything will be taught, presented from a practical perspective, and we'll be working through hands-on examples and projects throughout. By the end, students will be in a position to build efficient, scalable models with consistent and testable performance. And all of these things are important. You can't take one away and have a good strategy. This is a revised version of a course that Nick has been teaching at UCL to computational finance and risk management PhD and MSc students for the last 7-8 years. And
actually, Brian, can I jump in just to let you know? So I initially designed the course. I launched it for PhD students just to test the waters, to recognizing that while I was working in the area, there was a significant amount of material that was not proprietary that could be used to teach a course in this area. That was in 2016, and since then I've worked with a number of PhD students specifically on algorithmic trading. Meanwhile, I got together the course as an MSc course and got it approved to teach at UCL, University College London, and we've been teaching it for the past 4 years straight. It typically fills up. We've been guaranteed. Supposedly, it's capped at 50 number of students, according to the managers of it. But we've got over 100 signed up every term, and it's something that it really adds on to the quant finance that many of these students are actually already in the process of doing. So over the course of many years, aside from the PhD and the MSc classes, I've also taught online classes through Quant Hub, WES training, and also through Experify. I've had over 500 students who have completed earlier versions of this course. And now we've got a new updated version that we think is much more applicable, given what we know. The areas. As Brian has kindly put forward here, this course is a hands-on approach to building trading pipelines, from data to features to modeling to allocation to execution to performance and risk measurement. So it's so we know the process of building these systems, and sometimes there are parts which are skipped. Sometimes there are parts which are combined, but everyone has to do all the different parts, and we have to know them all. And that's what we plan on doing, is guiding everyone through all the parts of an algorithmic trading system.
Do we want to see if there's any questions at this point, or should we go through the syllabus? Does anybody have any questions?
We of course want to be as approachable as possible. I know it's not always easy in an online classroom context. Sometimes I've had these before where we had to prompt students to start asking questions. But please, anything in a chat room is perfectly reasonable too.
Anything at all. So I mean, and obviously at any point, I just thought this was a sort of a natural point to ask the question. And if anything had occurred to anybody so far. Nick, do you want to start off on the syllabus, and I'll jump in?
Sure. Okay. So the syllabus basically starts with an analysis of the industry, because the industry is pretty broad, and there are lots of different shops that hire algorithmic traders or researchers who work on, or strategists who work on algorithmic trading. From those which are fully systematic, like systematic prop trading, those are increasingly large shops entering into, for instance, the markets like the treasury market. There's lots of systematic prop trading in those markets. There are also the systematic hedge funds. Prop trading, you're trading for yourself. A hedge fund, you're trading for someone else. You're managing someone else's money. High frequency trading shops. There's a little bit of overlap here, but we know the names of many of the high frequency trading shops out there, and some of what the business that they're in what they're in the process of doing. So these are the much more high frequency side. On the medium to lower frequency, we have places like the CTAs. It was commodity trading advisors, what it was initially, but CTAs are a type of hedge fund that typically do trend following. And the CTAs, of course, try to branch out and launch other products, but CTAs, there are quite a number of them in London that are CTAs that is their core business. Meanwhile, there are algo trading teams or pods in multi-strategy hedge funds. Some of them just hire specific pods only to do algo trading. Similarly, there are QIS teams, quant investment strategy teams. In investment banks, it used to be done entirely in structuring, where they'd launch products based on rules. So it would be like a passive product, but it would be rule based. And then it became much more sophisticated over time. The QIS teams will launch things like trend following. They'll launch things like carry or vol risk premium strategies, and they will package them to sell to institutional clients. All of these are types of algo trading. In banks as well, there's e-trading or automated market making, where the banks are that's a high frequency sort of endeavor, or low latency endeavor, where they are making markets in many of the underlyings, and sometimes some markets are very well penetrated or very well by e-trading. Other markets are still in the process of becoming electronicized. And then we'll go through the capital markets penetration by sector, because, as I say, some sectors are very electronic, whereas equities or Forex or U.S. Treasury trading, there's a bit of a pushback. If you're in EGBs, so European government bonds, it's only partly electronic. Or there's plenty of other places where there's moves to make them electronic, and there are types of trading that goes on in them, whereas there are other types of algo trading which are yet to be done. So maybe we can skip ahead. Okay. Then we'll go into data sources, and this is a crucial issue for anyone in algo trading, anyone doing anything algorithmic, is to know where the data comes from, what you do with it, how you store it, how you clean it. It used to be ETL, and now it's ELT. We typically take raw data, we download it, and we store images of it, and then we're able to do any transform once again and again on that data. We've got data sources from Bloomberg and Reuters. The exchanges, lots of them sell their data. There are lots of third-party vendors of data, and some of these are very valuable, as well as exogenous scrape data, where it's web pages that post things that maybe it's the source for Bloomberg itself. There's like Treasury Direct is an amazing source of data for treasuries. I trade treasuries, so some of these scraped web pages are just an immensely useful source of data, and should be part of a flow. And then alternative data sources in some sectors are particularly important, whether it's we know people doing trying to figure out earnings announcements in advance by scraping web pages, by using satellite imagery, by doing geolocations of our iPhones and where our footfall is in shopping malls. There are lots of different there are lots of different data sources out there, and you have to know kind of the basics of them and where you might be able to get stuff and what you should be doing with it. I guess the next thing would be feature creation, because every model has features, and features. A feature isn't necessarily just aligning data, because a feature could be processed data, it could be augmented data, it could be the output of a model. So feature creation has to be done in production as an automated process and stored in a very accessible feature store. In machine learning, in machine learning engineering, which is now a sort of a blossoming field, they have the concept of feature store, which we very happily borrow. But typically in machine learning, there are lots of other things that a feature store can do. We're just interested in actually storing the data in a way that we can reproduce our simulations on an ongoing basis, but we also have very good metadata that tells us exactly when the data was, where it was populated from, what's in it, and so the flow is actually very well documented. Then we have to, then from there, it's pretty straightforward to do things like feature relevance, testing and filtering, and look at things like feature stability before you even get into modeling.
Okay, so I can talk about factor investing, perhaps. Equities are obviously a very widely invested in and relatively well understood asset class. And the fact that there are so many different equities in the US, there are 5,000 or 6,000, albeit some of them are extremely small, which gives you a lot of diversity. And so on any given day, there's, some stocks have got earnings announcement, other stocks have got something has happened where the CEO has resigned, or there's always things happening with individual stocks. So there's a lot of there's a big cross section of things going on day by day, in addition to the overall market itself going up and down, as we all know. So many attempts have been made over the decades now to model, to strip out the kind of the global factors from the idiosyncratic or the factors that are unique to an individual stock. And the initial attempts in the 50s and 60s were CAPM and APT, which have factors like the overall market itself, and then they started including other factors. Fam and French in particular had factors such as the value represented by a stock versus whether it's a growth stock, and the size of a stock. So big stocks perform differently to small stocks. So you can essentially, in theory at least, with enough factors, you can explain most of the return on an individual stock, because some stocks have got different exposures to the different factors. So they're like, you get a weighting on each factor for each stock. And this is the whole industry in itself. If you read any kind of output from an investment bank equity desk, they'll talk about these styles, these equity factors, where they'll say, well, value stocks went up yesterday, defensive stocks went down, quality stocks went sideways, et cetera, et cetera. So rather than talking about individual stocks name by name, or talking about stocks by purely their size, their market cap, they talk about all of these different features or styles or factors that you can use to represent stocks. And there are thousands of these factors. Probably less than 100 are widely used, but there are new factors appearing all the time in the literature. There's been many papers written about what are called factor zoos, where it almost seems like every week there is at least one paper published which claims to have found a new anomaly, which will then imply a new factor that people have heretofore missed out on. So it's a constantly but slowly kind of evolving area. It's important to know the terminology. It's important to know how the equity risk and equity returns are quantified in terms of these factors. And it's very, very sector or asset class specific, but extremely important. Can you do risk premium, Nick?
Sure. So I guess a little bit of a side thing from the factors is Brian was saying the factors. It's an industry unto itself. I mean, some of the biggest hedge funds in the world are basically managing equity factors. Risk premium strategies are rather than a pure explanation of how the stock market works. They are actually a rationale for how asset prices move. And so risk premium strategies would be things like trend following or momentum, where if a stock has been moving up or a commodity is moving up for some time, it's likely to continue to move up for some further time, and that's a type of momentum. There's the time series momentum, which is what I'm talking about as a risk premium strategy. There's the corresponding equities cross-sectional momentum, where in equities as a factor investing, they buy the winners and they sell the losers, where they buy the stocks that have been doing very well over the past year, and they sell the stocks that have been doing very poorly over the past year. And they do that typically in a cash neutral fashion, or potentially market neutral fashion. But that is meant to be that is a cross sectional momentum. The trend following is a time series momentum, and that is the basis for what how CTAs do their investment. And CTAs again are a completely different segment of the industry, but they are a very, very large segment of the industry. Another type of risk premium strategy is carry, where if curves stay the same, if markets stay the same, the bond gets 1 day shorter in terms of its time to maturity, and so it will roll down the yield curve, and as a consequence, it will become more expensive. So carry is just assuming that things are unchanged. What happens? There are some assets there's some futures curves which are downward sloping. There's some futures curves which are upward sloping, and so you sell the ones that have the negative carry and you buy the ones with positive carry. That actually forms a strategy. That strategy does well, except in periods of very high volatility. Trend following, on the other hand, does well, especially in periods of high volatility. So these two form a very nice diversification. Mean reversion is very similar to how market makers make their money, and mean reversion is typically on a much faster time scale. So that's something that some markets, because of the costs associated in the very rapid turnover, this could be a very costly strategy, and it's only possible in some highly liquid markets to do mean reversion strategies, unless you do them intraday. Relative value strategies, again, there's a tremendous amount of relative value trading in all these markets. People go long asset, one asset short another, a combination of another's. These are all things that can be systematized. Another type of risk premium strategy is statistical arbitrage. This again is an area in and of itself. I think statistical arbitrage is typically equities only. And it's typically very large portfolios of equities that are held. Volatility risk premiums, selling options and delta hedging them. That's a very well known. It's similar to a carry strategy, but with a little bit more of a zing. And then we have intraday factors, intraday risk premium strategies. And all of these can be compared to their cross-sectional strategies, which Brian mentioned on the previous slide, because there are similarities, although there's also dissimilarities. So, but in some sense, what we were talking about were how the features can be used to form simple strategies. The features as well can be used to form more complex models, where you forecast the expected return of a given of each asset class. And in order to do that, we have to know forecasting methods. And these include machine learning methods. So in this, we cover things like analysis and forecasting, from the very simple or really ancient, just using moving averages and double moving average models, the Holt-Winters model, to things that built on that, state space models and Kalman filters, models. In fact, there's a lot of overlap and just different approaches to doing pretty much the same thing. Although for instance, the moving average models are relatively simplistic in some sense, when it comes to international forecasting championships that have taken place every decade for the past several decades, typically they are close to the top, the winners of all these sorts of these actual forecasting competitions. Nowadays, the machine learning has surpassed them, but there's actually there typically is a very strong overlap with these moving average type of features. We'll also be covering multivariate methods, and PCA is very, very commonly done. The difference between stationary and non-stationary time series, where they come up in practice, and how you can trade them. Co-integration, which is a form of looking for stationarity among non-stationary time series. It's actually very similar to using PCA in some sense, but co-integration is a way of trading value. Then we'll cover VAR models and VARMA, which are multivariate forecasting models, and then we'll relate them to the simple state space models like local trend models and seasonality. Brian, maybe you should take on this one.
Sure. So to finish off, or to continue on with statistical forecasting then, and we'll see this in this, I think maybe in the next slide when we look at machine learning. There's lots of different decisions that have to be made when building a model, and you've got to choose the model clearly. You have to choose your features. You've got to choose whether you regularize, how you regularize. There's lots of these kind of added bells and whistles almost that you can add on, but there are trade-offs, there are cost benefits, there are pros and cons. So you need to understand what the consequences of these decisions are. And it's very easy to just use these models kind of out of the box without realizing what you're actually doing. And training testing sets are absolutely standard in all kind of back testing type approaches. But again, how you do that, how you hold out the data is an issue, particularly when you're dealing with time series data, because you can't just chop it up arbitrarily. And in finance, we're frequently, but not always, dealing with time series data where the time component is clearly very important, right? You can't just assume that you could do trades in any random order historically. And ensemble methods really have kind of evolved as a way of kind of grouping together these bells and whistles, as I call them, into packages which improve models, but again, they're not always, they don't always have desirable features depending on the problem at hand. And you can sort of stack models up. You can stack up ensemble methods. You can, it's often called a pipeline, where you can essentially add in, steps one after the other. And a big issue in time series, in finance in particular, is the whole idea of regimes and change points. So a lot of strategies will work great for a while, and then suddenly they won't work. And the reason generally is that there's been some fundamental change in the market, in the regime. Something has happened, and it's obviously very difficult to see that in advance. So the key thing with these regime switching models is, whilst you can't tell in advance when there's going to be a regime switch, you can spot that there has been one as quickly as possible and adapt accordingly. And then, as we've mentioned numerous times already, machine learning will play a big part in the course, as it does in the industry now. And there are loads of online adaptive filters being used, RLS, exponentially weighted RLS, common filters, which Nick mentioned earlier, random regressions. There's questions around, or decisions rather, around whether you use a batch model or whether you use online learning. And again, that which you use will make sense in some circumstances and not in others. And just the practicalities of your model parameters. Like, what do? Do you save them? Do you estimate them on the fly? Do you reuse them? How frequently do you recalibrate? And that all depends on the problem, the asset class, the domain. Are you trading intraday? Are you trading more slowly? What are you trading? And so on. And then the machine learning models themselves will look at all the top 10 hits, as it were, sort of Gaussian processes, random forests. We look at a lot of non-parametric statistics, which again, I think in some ways includes all machine learning models, but kernel methods in particular are very useful. And deep neural nets, wide neural nets, long short-term memory, reinforcement learning, autoencoders. Again, as where appropriate, we will apply them. What we won't do is just kind of give you a lot of theory to say, here, there's this cool thing called STM. Here's 20 slides of theory, and that's it. It will only be introduced and discussed where it is appropriate and where it is actually used practically. And then
perhaps I can just
go on.
So I think commonly a lot of machine learning and finance approaches just give you the basic machine learning without telling you how it's often used. And the actual case is there are a lot of models out there which are quite natural. For instance, if you're doing a Netflix recommendation system that don't fit so well within the finance context, primarily from the point of view we have very low signal noise ratios and we have non-stationarity, which means effectively we have very short time windows for which we can estimate things. As a consequence, there are lots of studies in the use of things like neural nets, but oftentimes they have to be quite restricted. They're not the most deep, they're not the biggest neural nets out there. They do encompass nonlinearity, and but they're very much constrained to the problem at hand to make sure that they don't go haywire on these wild data sets that we have to deal with. So
right.
I'll hand it over to you again. Sorry.
And in terms of the enhancements to machine learning models, then I'm not going to actually go through these one by one, partly in the interest of time, but also because we've kind of mentioned a lot of them already. But basically, you have a lot of decisions to make around how you test, how you improve, or do you use boosting, bagging, etc., regularization. So there's lots of different additions, if you like, to the basic neural network or other machine learning models. And one big issue that's very relevant in many cases is performance. So memory usage, speed, and even just for the sort of examples we'll be using, which won't be absolutely huge, but performance is really important. And different programming languages have different features in this regard, in good and bad. So we will look at some of that, and we will sort of discuss in detail, where you can go badly wrong by using a particular programming language. And microstructure and slippage. So probably, if I had to guess, aside from errors in testing and with the statistics, I'd say the biggest error people make when creating a strategy, which they'll tell you is absolutely amazing, is that they have either forgotten about or implemented incorrectly their estimates of transaction costs. So clearly we can't trade with zero cost. So everything has to be accounted for, both in the back test and in any kind of forecast of future profitability, any performance testing. we need to have some, because when we're looking at historical data, our trades weren't in there. We weren't trading at that time. So if I'm assuming I buy 100 of something at a point in time, that may move the market. And so the history has now gone down a different path. So you need to incorporate things like market impact, which is essentially, if I did this trade, what would happen? Where would the market be as a result? So I've got the initial cost of that trade, but also my subsequent trades could be affected because the market may move and not, immediately come back. So all of these things are what it's called slippage. You need to think about how fast you need or want to trade, what your tolerance for execution costs are. So there's often the trade-off between the cost of execution and the speed and the guarantee of execution. So if you're not so concerned about definitely doing a trade, then perhaps you can improve your execution costs. But if you need to do a trade, you need to do it now, and it's a big trade, your costs will be bigger. So all of these things have to be factored in. So that's, yeah.
I was going to say, so these also, you'll see, and it's something that we've experienced, is that this actually matters for instance, how different strategies are designed in different fields. So, like for instance, in a QIS desk, which typically is selling an index swap, the index swap is based on a given strategy. They need to have it filled at the end of the day. Maybe they have to have it filled at the VWAP or the TWAP, depending on what the index the documents say. And as a consequence, they may not. There are certain strategies they may not that may not be economic for them. That if you're in a hedge fund, it may be completely economic for you. So there's a lot of there's some interesting nuances in here based on sort of institutional rigidities.
That's right. Yeah, who you are, whether you're executing electronic versus voice, what sort of deal you've got with your prime broker, et cetera, et cetera. So these are all real issues that over time on any strategy can have a dramatic effect and need to be considered. And as you all probably know, there are different types of orders as well, particularly on exchanges. So you need to be aware of how that will impact these market impact, trading costs, slippage, etc. You do portfolio allocation, Nick?
Sure. So for portfolio allocation, there are many different ways of going about doing this, but essentially it's doing something like mean variance optimization, and we have to think that way whether we really believe in MVO or not. We have to use the Marco. So MVO has pros and cons. It gives us lots of good intuition, but if it's implemented like right out of the box, it has some shortcomings and means of improvement. Now, what people do regularly is called tax asset allocation. They plug in their models. They plug in their forecast for the alphas. They plug in their forecast for the risk model. They plug in their estimates of the transaction costs, and then they go away with it. Now, there are lots of tricks for how you do this, because it's a nice, simple quadratic program typically, but you can put how you can put transaction costs in or turnover constraints, net gross limits, you can control risk managers, sector limits, whether you're doing no short, if you're a long fund. It's also possible that you maybe don't want to hold a very large portfolio. You can actually implement such portfolios using just appropriate constraints. Now, some people would say that the whole 9 yards and putting in an allocation method is overkill. And a lot of CPAs just have a simple rule. They have their alpha source and they have some nonlinear transform of the alpha source. The alpha source is positive, they go on up to a certain number of units. And then if it's way too positive, they think something's gone wrong and they start to get out. So they look at things like the shape of the it's like a sigmoid shape. Is it an inverse sigmoid shape? What are the different properties of that? That's what a typical CTA would do. Now, at this time, it doesn't help you when it comes to how you allocate from multiple at once. Now, then you have things like restricted strategies. Some of the largest hedge funds in the world just do risk parity. Just asset class. You put less in equities because it's a highly volatile asset class compared to fixed income, except recently. Now, is you put more in fixed income as a consequence because you want to sort of enhance its returns. And there's similar sort of factor analogies that a lot of the investment in quant strategies has been in what's called low beta strategies or minimum risk strategies. These low beta strategies actually have surprisingly high performance. It's a type of anomaly. And so we'll cover that as well as things like hierarchical strategy, but applying it to markets that can be potentially not just completely uncorrelated. So,
I can take on back testing, simulations, and parameter tuning. So as part of any strategy, obviously, we need to do some testing to figure out whether it would have worked historically. That's generally a starting point. And whilst doing that, though, there are, as I noted earlier, there are kind of right ways and wrong ways of doing it, and there are pitfalls to do with multiple hypothesis testing and kind of, essentially abusing the data, really. And the transaction cost issue, which I touched upon a couple of slides ago, is absolutely central to our backtesting and simulation. We need to measure our performance somehow. So how do we know how well a strategy is doing? Well, we've probably all heard of Sharpe ratio, but there are many alternatives such as Sortino, Omega ratio. We can look at the drawdown specifically, which is often of particular concern to investors for obvious reasons. What's the potential for a serious drawdown? And then other measures as well. So other measures of risk versus reward, other measures of, what's the probability of X, Y, or Z happening, kind of VAR type measures. And another issue is, are we optimizing a single thing? Do we just care about return? Or more commonly, do we have multiple objectives, which is generally the case. So we're generally trying to optimize return, but within a framework of some sort of limits or some kind of maximum drawdown or maximum volatility, etc. And there are many different optimization techniques, everything from sort of the basic convex optimizations all the way through, the steepest descent type methods, and then you can use genetic algorithms. Often work quite well in this space because you have often got multiple maxima, local maxima. And for risk management, then we've probably all heard of VAR. Expected shortfall is also widely used nowadays, and regulators look at it increasingly. The focus of risk management does vary depending on the institution you're in. So what you spend your time doing in risk management in an investment bank will be quite different probably to what you end up doing in a hedge fund for a variety of reasons. And we kind of look at some of the nuances there. We won't necessarily get into the regulation too much, but we will look at the typical type of profile of portfolio, shall we say, that a hedge fund might have, a particular type of hedge fund versus another different type of hedge fund versus a prop shop, etc., etc., etc. And the issue of funding is never too far away nowadays. So you've got to consider where your cash is coming from, what you're doing with excess cash on a overnight basis. So when you're building a backtest or a simulation, you will have cash generally flying around, possibly in multiple different currencies. You have to figure out, you have to build in to your test. Well, what do you do with that? Is that earning any money on a daily basis, et cetera, et cetera. So all of these kind of issues around funding, if repos, et cetera, if you're doing, bonds, they're all very, very central to deciding whether a strategy actually works or not. And stops, trailing stops, these are kind of order types really. So how you're actually implementing your your stop strategy. That's a critical part of risk. So there'll generally be limits around your maximum daily drawdown, maximum exposures, and various different dimensions. So all of that will be kind of factored in. And this really feeds into the kind of the back testing simulation bit, really. So you need to take account of all of this in your optimization, because you're going to be subject to it. So you can't just pretend it's not there, build a strategy, and then find out, oh, actually it doesn't work, because the risk is out of control. And Nick, do you want to start off in the prerequisites? So this is the prerequisite assessment then for the course. You're on mute. Nick, you're muted. Oh, I'll start off. The first prerequisite is intermediate or.
Oh, wait, sorry, Brian. I somehow I've been muted, but sorry. There's two basic sets of skills that you need as a prerequisite in order to take the class. And basically, we're assuming you're an intermediate or experienced programmer, preferably Python, just because it's easier for us to convey everything in Python. In some venues, you're doing it not in Python, but in KDB and in the Q language, or you'd be doing it in C++.
Nick, I'm sorry, we've got a problem with your sound.
I'll jump in and do this. It's breaking up slightly, Nick. Assuming I'm okay, then the first thing, as Nick was saying, is just we need people to be intermediate or experienced programmers, because we will be diving straight in to working with Python, and so you need to come with a good working knowledge of Python. As I mentioned earlier, other languages are widely used in this space, but Python is just a good way of illustrating everything, and people are often familiar with it. Statistics and machine learning or statistical learning, we will assume a fair number of statistical concepts. So, you do need to be familiar with, hypothesis testing, sort of the p-values, how, the basic distributions, be, comfortable with all of that. And OLS, ordinary least squares, so linear regression is an absolute minimum. So you need to be absolutely comfortable with all of that, and preferably have a little bit more knowledge or comfort. In terms of finance, strangely, it might seem, is possibly slightly less important in many respects, in that there will be jargon that you may or may not be familiar with, but the actual difficulties will probably lie more with the programming and with the statistics side of the econometric side of things. We don't necessarily need a huge knowledge of finance to work in algorithmic trading. At the end of the day, aside from the kind of the nuances of each individual market, etc., it is fundamentally working with data, testing, building models. So apart from things like, utility theory, which is used for optimizing strategies, we won't actually require huge knowledge in that area. A plus would definitely be some familiarity with stochastic differential equations. So this kind of starts with sort of Brownian motion and kind of diffusions that many of you will be familiar with, but it's really the kind of the mathematics around that will be quite useful. It's mainly used in the kind of the options derivatives world, but some of the equations, some of the terminology we will use will rely a little bit on that. So whilst you don't need to be an expert in it, it will kind of make your life a little bit easier if you're familiar with that kind of notation and kind of how that works.
I was going to say that comes in particularly in things like execution, automated execution, automated market making. So the higher frequency stuff typically uses stochastics and stochastic control, whereas the lower frequency is almost entirely just pure statistics or pure time series statistics.
Yeah. And then, do you want to do assessment, Nick? Are you?
Yeah. So the assessment, now this is actually a tried and proven way of assessing. This is something I've done in my course at UCL. Essentially, is a written assessment at the end, and it's where you produce a PDF and an IPython notebook describing a strategy in detail. Now, whether it's behavior, its rationale, its implementation, and its performance, you have to go through them in the beginning to the end, like why you designed that strategy, how you went about doing it, where you got the data set. This is very good practice, of course, because in some instances you'd have to actually go through this in order to be able to launch your strategy as part of a team. But it's also good practice for yourself to get it done. And then you look at also things like the limitations and room for improvement, because anyone who's launched a strategy should know that there's no such thing as a perfect strategy. You can have some amazing strategies, and there's still room for improvement. So the marks on this will be for the sensibility of the coverage and exposition, for following the methodologies, because I say there is room, as you said, it's not just going to be on performance. Good performance is great. Everyone will love great performance, but there is room for even, not such great performance as part of a portfolio. Maybe it helps you diversify. So analyzing the strategy and knowing how it behaves is crucial. And so you have to display it and explain it. And based on that, we will give you feedback on what you've done. Feedback and marks. So I guess wrapping it up, the takeaways here is that algorithmic trading is a large and growing part of financial markets, and especially with the advent of increasingly sophisticated machine learning algorithms, it's only going to become more relevant over time. It's going to dominate. It dominates some markets, but it's going to dominate them even more as time goes on. As an area of study, it's actually surprisingly new. There's not many university courses out there that do this kind of thing, and others, if there are any, they focus on purely mathematical aspects, and they neglect the analysis of what risk to take and how much to take of it, the kind of thing that generates returns. And finally, Algorithmic Trading Practitioner's Guide is aimed to give you the practical skills for getting started in this area, and that is our goal, is to convey to you what we've known from our time in the business, to let you know what are the essentials for you to actually get moving forward.
That's the lot.
Yeah.
Any questions? I stop sharing.
So I should tell you, just as an answer to your questions, my video is not going to feature prominently in the course because we'll be doing it live and recorded professionally. So no need to worry about any glitches there making a difference. And I say one of the pros of doing it live, we've done online, we've both done live classes and online classes. And online, it's sometimes a little difficult to get the level of interaction that you can in a live class, as well as it's not always easy in a live class as well. But just making sure that we're there to answer questions and interact, and it helps to guide the emphasis of the material.
Mohammed, do you have a question? Gonna unmute, yeah.
Hi, Brian. Hi, thanks both for presenting. Two questions actually. So the first one is, Geoff shared, the outline of the course. It shows that it covers 12 modules over 4 days. So one question is, are you going to rely on people doing a lot of reading on the side? It does seem like quite a tall order to cover over 4 day period, especially if you're going to be going into like practical considerations as well as theory, as well as programming. So that's part one of the question. And the other part is around the project itself? How much time will there be for people to work on the projects?
Right.
Thanks.
So Brian, maybe I can start.
Sure.
We're going to, so some areas, of course, we can only we can touch on and guide you through and give you readings on, because that's a crucial issue. Is that it's impossible to go deep into such a wide breadth of information. Now that said, there's relationship between this course and the university course I taught at UCL. The UCL course is a 30-hour course. And so it's 3 hours a week. Of course, there's lots of time to absorb things in between. It's a 30-hour course. And our course, so we can offer pretty much the same level of detail as that, going into great depth into most, if not all, of these areas, and guiding the students and giving references and guidance and sort of materials for anything else. So Abhijit was asking about LFT, HFT, so and ultra HFT. There's something I'm going to say I don't have exact definitions for, but typically we think of HFT as sort of being very low latency, so that in the matter of milliseconds, the order is transacted, if not quicker than that. The medium to low could be trading a couple times a day to holding over several days. And so, for instance, some of the high frequency trading shops, places like Jump Capital, or I would say Virtu does both, but they're used to doing high frequency, not even holding any risk overnight. And recently they've tried to branch out, where for branching out, that means they say, well, we'll hold it for 2-3 days, which is quite different from a CTA, which could hold a position for a month. Brian, do you have something to add?
No, I think you're right. I mean, I don't think there is any accepted definition of any of these things, really. I think it's in the eye of the beholder in some ways. I think you kind of know it's high frequency when it's clearly trading multiple times per second, and potentially in lots of different markets at the same time. So I know that now the New York Stock Exchange ticks in nanoseconds. So, you can actually trade potentially every nanosecond. I think in reality, 100 nanoseconds is kind of, just probably a bit more realistic, but it is that kind of down to that level of speed. And so latency, as Nick said, is the be all and end all for these guys, really. So I don't think there is a straightforward answer. You just kind of know it when you see it.
So Marcus asks about, is it suitable for young professionals who are interested in transitioning into PM role or a senior position within the respective firm? So I would say that this course is sort of, it gives you the essentials for moving towards that sort of direction. It does, however, not give you a track record. So a lot of places, in order to become a PM, suppose you want to be a quant PM and you want to join a multi-strat fund, typically you're going to ask for track record. You can only get a track record if you're working as a junior with a more senior quant PM, and you can claim some of that track record as your own. But I mean, there's nothing that sort of escapes that. But there are, of course, places that will take you straight out and put you on the desk working with these slightly more senior people, and we're giving the background for how this setup should work.
Yeah.
How is uncertain events going to affect algo trading? So that's actually a much harder one. There's going to be, there's lots of uncertain events, and there are things like flash crashes. There are things like There are uncertain events that I'd say that so there are uncertain events like the runaway inflation that really changed the approach to how the Fed started operating, and it started to affect a tremendous amount of the U.S. yield curve. Or Liz Truss's government announcing its budget, its mini budget.
Yeah.
So all of those have a potentially large, impactful effect, and all of those require some form of risk management system, some tool to sort of prevent things from getting out of control.
Yeah. I mean, unless you've been living under a rock for the last few years, you'll have noticed that there are more and more articles and everything and news stories about, you know, AI, automation, and the effect it's going to have on potentially jobs and all that. But this is just that really happening in finance, right? So the automation is going to happen, and algo trading will take over in every market. There's absolutely no doubt about that. The uncertainties, apart from the one that Nick has mentioned, like the macroeconomic uncertainty, the war in Ukraine, etc., there are uncertainties always around regulation, and regulation can have an impact. Like if there was a massive flash crash caused by algos, then the SEC or FINRA, you know, whatever regulator could decide that certain types of order type, which they have done in the past, right? They keep moving the goalposts on what type of orders are available and legal, say, in equities and securities markets. And that will keep happening. There will, but all that does is it just essentially moves the focus elsewhere, you know, on the type of things that people trade and how they trade them change slightly, but it doesn't alter the fact that there will be algos that are doing the trading. So
Mitanshi has a question about, would AI inclusion already make some of these strategies obsolete? I'm going to say no. AI can make some of the strategies better if it's used properly. It can help to enhance the returns of some of these same strategies, but some of the strategies are a bit more fundamental. Like for instance, even the trend following strategies. There are lots of explanations for momentum, but some of it is costly information. There as a reason for herding. So AI makes the strategy. So it may have the it's at times proven to help the strategies work better, but it doesn't make them obsolete because there's still plenty of juice in a lot of these strategies.
I mean, yeah, I can completely agree. It does. There is obviously a bit of an arms race going on where, you know, you have to keep improving, and even with you know, you build an algo, you're not done. It's, you know, it won't work forever. It has to be continually improved. But I mean, to give you some examples of, like, discretionary trading in general is being killed by AI. I mean, people just can't move or decide things fast enough. It just simply is not possible. You know, a computer can make a billion decisions when you make one. You know, and this is very apparent in, you know, to use the equities example, that you literally used to have, when Nick and I started in this business, hundreds of people in banks whose job was to read through the financials of companies, literally actual people reading actual financials on paper, and then figuring out, oh, I think this company could be a bit of a buy, right? Now you have an AI listening to the earnings call in real time and sending a signal to buy or sell the stock, because of something the CEO says or doesn't say, or the tone of their voice, or, you know, whatever it might be, or listening to Janet Yellen, or to, you know, whoever's speaking. I mean, it's totally transformed that entire industry.
I saw a talk by the guys at Bloomberg who do NLP, and they're looking at the peaks of activity after a corporate announcement, corporate action. And it used to be there was like a 3 millisecond and a 3 second rule. That used to be a very small amount at 3 milliseconds, a very large amount when people actually read it and processed it, and within 3 to 5 seconds they actually started to trade on it. Now the peak is completely the opposite, where most of the activity is in 3 milliseconds. So people can't keep up with that. You've got to use your intuition and your knowledge of how markets work to program that machine to trade to implement the trade properly. Some of those are pretty straightforward. When it comes to an earnings announcement, there's some sort of surprise. Event-driven strategies are those. Fortunately, those are tried and true, and you don't have to worry about them drifting too much. Sebastian, sorry, asked. We'll cover footprint.
I mean, perhaps this is referred to microstructure in general and price impact and order flow. Yeah, it will absolutely cover that. So this is particularly relevant, again, when you're designing your testing and simulation. So you need to kind of factor in your own impact, right? And, the things like the liquidity of the market, does that vary throughout the day? How best to execute? How, do you split your order up into lots of sub orders, et cetera, et cetera. So there's lots and lots of individual decisions, each of which can be quite consequential in the overall performance of the strategy. And I hope, Sebastian, that answers your question, but feel free to clarify if not. Okay. Well, I guess we're over time. Okay, crypto. Yes, it is. There are differences in the crypto market, so particularly on the data side, where it comes from and what form it takes, and there are, differences around smart contracts and other things, and how the funding works as well is a big difference. But fundamentally, if you have the data and you have the ability to program up the strategy, then yeah, absolutely. You're on mute, Nick.
Yeah. Okay. So I don't know why that happens, but yeah. So I know traders have moved from trading normal regular capital markets into crypto. They say that it's initially they say that it's extremely refreshing not to have to pay attention to announcements, to macro data. That the crypto market is very much is typically an entity onto itself. So that's but there's a lot of algo trading. Algo trading in crypto markets is a huge activity, and so definitely we'll cover that.
And in terms of the interaction between algo and I guess there are always biases, and you have humans who are programming, the strategy. So ultimately, that in itself can introduce bias. I think the big bias actually is often the kind of for want of a better word, like a herd mentality, where you've got you see this a lot in CTAs, where there's lots of them, and they're kind of trading similar futures in similar ways. And so you get this sort of effect of, kind of a reinforcement almost, where, they're kind of trading with each other because, one buys and then the others all jump in and buy. So I think sort of bias is the right word for it. But there are undoubtedly human biases which have been well documented, and they affect traders as much as anybody else. And Many of them, I'm sure, have been incorporated into algos. Now, whether we'll ever get rid of them, I don't know. Probably not.
But it's an interesting area is how there's always going to be a level of human interaction, because there's a human who designs the algo, there's a human who controls it, human who reevaluates it, and it's an interesting area. And I actually know a sociologist of finance who study these sorts of things, how much people actually rely on algorithms for the things they do, and whether that's how that's changing through time. Do you recommend any direct market? Ooh. So, okay. So it looks to me like Sebastian's actually asking about slightly more on the retail side, DMA for placing orders ourselves. That's something that I'm going to say I don't know about so well, because we're looking at it primarily from the point of view institutional, as opposed to setting up your MT4 account and hooking up to your retail broker. That one I don't really know so well. It's certainly feasible to implement these strategies there, but when it comes to the hookup itself, that one we're not sure about. There, you have to study the API and make sure you can interact with it, and it can execute the orders you want it to. So did we miss any questions? There's one more. Oh. So, okay. So can you receive materials? And I say absolutely. That's the goal, is to give you the material, the PDFs. There's going to be many resources we want to give, because it's like we're giving you our time and effort, and we've compiled quite a lot of material here, and that's definitely you will have access to. There was a question before we didn't finish answering. How long will we give for the final project?
That's right.
And so I was going to say we haven't. So Brian and I didn't decide fully, but I think typically it's about 2 weeks is pretty reasonable.
Yeah.
But there's some room. There may be some room for negotiation.
I think so.
I mean, the goal is for you to do something that you're going to be proud of at the end, that you think you've done that job and you've done it well. And I've known people in my class at UCL who have actually written it up and submitted it to employers as this is what I've done, and so it's actually, I think that's a very valuable sort of stepping stone towards moving forward. Okay.
Kind of guessing we're moving towards the end of this session.
Yep.
But first of all, Nick, Brian, thanks very much. This was unbelievably eloquent and very clear, everything that you explained and how you answered the questions. So thanks very much for this presentation. If anybody has any questions that pop up in the coming hours and days and weeks even, then just feel free to get in touch, and we'll do everything we can to answer your questions. The bootcamp takes place from the 4th of September, I think.
Yes.
It starts on the 4th of September. Yeah, so you should all have my email address and my got 2 contact numbers. Just in case you haven't, I'll put them in here. There's my email address, and then UK number is there, and a French number is there. Okay, so any questions, then feel free to ask. Any questions that you want to refer to Brian or Nick as well, they're extremely busy, so come through to me. I'll then put it to them and they'll respond promptly as they always do. And thanks very much for listening in. And I hope you found it really, really useful. Many thanks.
Thank you. Okay.
Thanks all.
Take care. Okay, bye-bye.
Bye-bye.